Hey everybody, welcome back to Drawbridge Finance. You guys know I have been doing math for most of my life. I mean, when I was very, very young and I first encountered math, I fell in love with it immediately. And one of the things that I love about math is the absolute simplicity of it. I mean, there's a very definitive and clear answer to every equation. If we do the math correctly, we can get the exact result. And there's something about that I personally just love. It's very black and white. And it is very unusual for me to be posed with a question that I don't immediately have an assumption on, like, oh, I'll be like, oh, well, that's the answer. Here's the question, and this is the answer, because I've done math so much. And I was recently approached by a viewer, and he asked me a question, and it stumped me. I really had to think about it. In fact, I had to go to my charts and modify one of my charts to get the right answer. And that's what we're going to talk about today. Hey everybody, welcome back to Drawbridge Finance. My name's Levi Woods, and this is an opinion channel about money. I'm not a financial advisor. I'm not offering financial advice. And occasionally I get, well, not occasionally, all the time, I get asked questions from subscribers, from viewers, from Patreons, and I encourage that. I love to interact with the community that I've built online. And this question comes from a viewer. We're going to run through a scenario using the exact numbers that he's provided. Now, I'm going to do this with fictional characters so we can kind of see through the progress of what's exactly happening. So there's two mortgages. The first mortgage is the original balance was $205,000 and the fixed mortgage rate on 30 years is 5.25%. Now the second mortgage is $195,000 and it's at a fixed 30-year mortgage of 4.75%. So the question posed today is, if there was $1,000 monthly extra payment being made, would it make most sense to put it towards the first mortgage at 5.2%, or the second mortgage at 4.75%, or split the difference and put $500 towards each mortgage? So I thought we'd run some scenarios and see what the result is. So the first thing we're going to do is we're going to start with my mortgage calculator, which you guys can download on Etsy. I'll put a link up here. There's also a link in the description down below. Also, my patrons are available to download these files if they're interested in that. So if you're interested in becoming a patron and supporting the channel, that would be amazing. There's a link at the end of the video for that as well. So just taking a quick look, this is how the file comes when you download it, and it's got really basic information. You put in the loan amount, the interest rate, the term of the mortgage, and it pops up the regular monthly payment. So what I've done is I've actually modified this slightly. I've created a little summary sheet here because I'm going to run a couple of different scenarios. So we've got 5 characters: Alice, Bob, Charlie, Doug, and Alina. Each of them are going to pay $1,000 extra towards their mortgage payment. Now this is $1,000 above and beyond their regular mortgage payment. So we're going to use the calculator, the amortization chart, to tell us what the normal payment is. And then we're going to plug in some numbers and see which benefits the most, which one we can pay off sooner. I've modified this chart a little bit for Alice. We'll run Alice's scenario first. So what is she going to do? She's going to pay $1,000 to the high mortgage first. So basically I made a copy. On this left side, there's the $205,000 5.25% mortgage. And it's a 360 months, so 30 years. So the regular monthly payment is $1,132. Now we're going to say that this started in October of 2018. Now I've copied the chart and I've put it right next to it, and I've kind of offset it down. So this is the second mortgage, so $195,000. The interest rate's 4.75%. Again, a 30-year. The regular monthly payment's $1,017. So very, very similar values. Now this mortgage was started in June of 2019, so just a couple of months ago. And the question is, if we put $1,000 towards either the 5.25% mortgage or towards the 4.75% mortgage, which one is going to pay off faster? So you can see I've put this information in. So Alice is putting $1,000 to the high mortgage first, $1,000 each month, not making any extra payments to the 4.75% column. So we're going to scroll down here and you'll see the result of what happens. In October of 2029, she'll have paid off this mortgage completely. So she'll be mortgage free on the 5.25% mortgage. And then she'll take that extra money that she would normally be putting towards this mortgage, as well as the extra $1,000, and start paying down the other mortgage. So there's quite a few extra payments now because she doesn't have this regular payment to deal with. And The result is going to be May of 2034, completely mortgage free. Look at the summary here, and you can see that the first mortgage, the 5.2, would be paid off in 132 months, and the second mortgage would be paid off in 180 months. Total interest saved $66,000 by paying early, and on this one, the interest saved would be $135,000 by paying early. So now let's just run a little scenario with Bob, and Bob's going to do the opposite. He's going to put the $1,000 towards the 4.75% mortgage and make regular payments only to the 5.25% mortgage. So we'll scroll down here. So similarly, in August of 2029, this mortgage will be paid off and the extra payments will go to the higher rate mortgage, the 5.25. So in August of 2034 would be completely paid off. Not a huge difference by any means, a couple of months. And we'll just look at Charlie, what would happen if he did 500 to each. And basically you're making mortgage payments all the way down and they get paid off almost at identical times. It ends up in July of 2034, completely mortgage free. Now, I also went a little bit further and thought, okay, well, what happens if we run a few other scenarios? Like what if Doug does 700 and 300 or Alina does 800 and 200? And what happens? And we can see the result of this, but basically what happens is that Alice is mortgage free in May of 2034. Doug and Alina actually came in really close. By doing this little strategy, by adjusting and putting some money towards the higher rate mortgage and some money towards the lower rate mortgage, they were able to get very, very close, but they still paid a little bit more in interest. So the definite winner here was Alice. Paying the $1,000 towards the higher rate mortgage benefited her in the long run. And even with those mortgages being offset on their start date, it's just that basic math of we put our money towards the highest rate that we're paying debt-wise. Anyways, that's today's video. I hope you guys enjoyed that. Remember to hit that like button down below. If you're really loving the channel, remember to share it on social media because that helps my channel grow. And so we can all get rich together. Talk to you very soon.